Meet Daniel. He is 24 years old, and he is sitting on the edge of his bed at 11 at night, scrolling through his banking app, wondering why nobody ever taught him how money actually works. He has a decent job, he pays his rent, he covers his phone bill and his groceries and his car insurance, and at the end of the month, there is almost nothing left except one number that keeps showing up no matter how he budgets it. $500. Not $5,000. Not $50,000. $500 a month. And for a long time, Daniel assumed that number was too small to matter, that real wealth was built by people with trust funds or six-figure salaries or some secret formula nobody ever explained to him in school. Then one night, he reads something that changes the way he sees that $500 forever. And it is this: the amount you start with matters far less than most people think. What actually matters is whether you start at all and whether you keep going when it gets uncomfortable. So Daniel makes a decision that feels almost too small to be dramatic. He sets up an automatic transfer of $500 every single month into a simple, diversified investment account, mostly low-cost index funds that track the broader stock market. And he tells himself one rule: he is not allowed to touch it, no matter what happens in the news, no matter what his friends are doing with their money, no matter how loud his fear gets. In the first year, nothing exciting happens. His balance goes up a little, then down a little, then sideways for months at a time. And if you had shown him a screenshot of his account after 12 months, he probably would have felt disappointed, because $6,000 of contributions had only turned into something like $6,200, and that is the part nobody shows you in the highlight reels online, the boring middle where compounding hasn't kicked in yet because there simply hasn't been enough time. This is where most people quit. Somewhere around 18 to 36 months in, when the excitement of starting has worn off and the numbers still look unremarkable, the temptation to stop, or worse, to pull the money out and try something flashier, becomes very real. Daniel almost falls into that trap in year 2 when the market drops sharply over a period of a few months, and his account, which now holds around $11,000 of his own contributions, is suddenly worth closer to $9,000. He opens the app, stares at the red numbers, and feels that specific kind of financial fear that makes your stomach drop, the kind that convinces perfectly rational people to sell everything and lock in a loss just to make the anxiety stop. But Daniel remembers something he read about a strategy called dollar cost averaging, the simple idea of investing a fixed amount on a fixed schedule, regardless of what the market is doing, which means that when prices fall, that same $500 buys more shares than it did the month before, and when prices rise, it buys fewer, and over a long enough period, this rhythm can smooth out the ride instead of forcing you to guess the exact right moment to jump in. Research on investor behavior backs up why this matters so much psychologically. Study after study on past downturns has shown that a meaningful share of investors who panic sell during a crash never come back to investing at all, turning a temporary paper loss into a permanent real one and locking in the exact opposite of what they were trying to achieve, which was financial security. Look at what happened in 2008 when the broader stock market fell by roughly half from its peak amid a global financial crisis. It felt, to almost everyone living through it, like the system itself was breaking. Some investors sold everything near the bottom out of pure fear, and in doing so, they missed the recovery that followed. A recovery that, by around 2013, had brought the market not just back to even, but into a new multi-year bull run. The people who kept contributing through the worst of it, who kept buying shares while everyone else was terrified to look at their statements, ended up buying some of their cheapest shares of the entire decade without even realizing it at the time. Then, just over a decade later, it happened again in a completely different way. In early 2020, a global pandemic triggered one of the fastest market crashes in modern history. Over 30% in a matter of weeks, unemployment spiking almost overnight, headlines everywhere predicting the worst. And once again, investors who sold in a panic locked in devastating losses, while investors who held on, or who kept investing through the chaos, watched the market not only recover within months, but push on to new all-time highs by the end of that same year. This pattern, fear at the bottom followed by a recovery that arrives faster than anyone expected, has repeated again and again throughout market history, and it is one of the most well-documented and least intuitive truths in all of investing. Here's the part that should genuinely change how you think about market timing. Some of the market's best days in history have happened within days or weeks of its absolute worst days. Research from major financial institutions, analyzing multi-decade periods of stock market returns, has found that missing just the 10 best trading days over a 20-year stretch can cut an investor's total returns roughly in half. And missing the 20 or 30 best days can gut those returns even further, sometimes turning a strong long-term outcome into something barely better than doing nothing at all. The reason this matters is brutal in its simplicity. To successfully time the market, you don't just need to guess when to sell, you also need to guess exactly when to buy back in. And because the best and worst days cluster so closely together, In the exact moments when fear is highest and everyone is convinced the world is ending, the investors who step away to protect themselves often step away right before the sharpest rebounds. Daniel didn't know all of this the night he almost sold. He just knew one thing. He had started this for a reason bigger than any single month or any single crash, so he left the account alone. And the following month, he made his $500 contribution like clockwork, buying shares at a lower price than he had a few months earlier without even trying to. This is the quiet engine behind long-term investing, a concept usually explained with the word compounding, but rarely felt until you've lived through a few cycles of it yourself. In simple terms, compounding means your money doesn't just grow, it grows on top of its own previous growth. A dollar you invest today doesn't just sit there waiting to become $1.10 next year if it earns a return. That return itself starts earning a return the following year, and the year after that, and so on, quietly snowballing in the background, whether you're paying attention or not. Over short periods, this effect is almost invisible, which is exactly why so many beginners give up too early, assuming their strategy isn't working simply because the first few years look unremarkable. But stretch that same process out over 1, 2, 3, 4 decades, and the math starts to look almost unbelievable. Historical data on major stock market indexes going back nearly a century shows an average annual return in the neighborhood of 9 to 10% before adjusting for inflation. And while no single year ever looks like that average, some years soaring 30%, other years falling 20% or more, the long-run trend across rolling 20 and 30-year periods has consistently pointed upward. This is why the age you start investing matters so much more than most people realize, arguably more than the amount. Consider two hypothetical people, both investing the same amount of money every month at the same assumed rate of return, the only difference between them being that one starts 10 years earlier than the other. By the time both reach their 60s, the early starter doesn't just end up with a little more money. They often end up with roughly double what the late starter has, despite having contributed only modestly more out of pocket over their lifetime. 10 extra years at the start of the journey can be worth more than an entire decade of extra contributions at the end of it, because those early dollars simply have more time to double, and double again after that. This is sometimes described using something called the Rule of 72, a rough shortcut for estimating how long it takes an investment to double at a given rate of return, and at historical stock market averages. That doubling tends to happen roughly every 7 to 10 years, which means a dollar invested in your 20s might double 4 separate times before you retire, while the same dollar invested in your 30s might only get the chance to double 3 times. And that single missing doubling period can be the difference between a comfortable retirement and one spent still worrying about money. Back to Daniel. By his late 20s, his income starts to grow. He gets a raise, then a slightly better job offer a year later, then another raise after that. This is the exact moment where most people's wealth building quietly stalls out without them ever noticing, a phenomenon often called lifestyle inflation, where every extra dollar of income gets absorbed into a nicer apartment, a newer car, more takeout, more subscriptions, more of everything, until someone earning twice what they used to earn is still living paycheck to paycheck, just at a fancier paycheck to paycheck. Daniel had read enough about this trap to want to avoid it. So instead of letting every raise disappear into upgraded spending, he picked a simple rule for himself. Whenever his income went up, at least half of that increase would go straight into his investment contribution before he ever had a chance to get used to it. His $500 became $650, then eventually $750, then eventually a full $1,000 a month. Not because he was suddenly wealthy, but because he refused to let his spending rise as fast as his income did. This single habit, treating a portion of every raise as an immediate increase to your investing rate rather than an immediate increase to your lifestyle, is one of the most quietly powerful financial decisions a person can make, because the money you never see is money you never miss, and it compounds exactly the same as the very first dollar you ever invested. Now, here is something important that Daniel had to learn the hard way before any of this could even start working properly. Investing every extra dollar you have, the moment you have it, is not actually the smart move, at least not at first. Before he ramped up his contributions, Daniel had to build something less exciting, but arguably more important, an emergency fund, a separate pool of cash, kept out of the stock market entirely, sitting in something safe and easily accessible like a high-yield savings account, sized to cover somewhere between 3 and 6 months of his basic living expenses. Without this cushion, a single job loss, a surprise medical bill, or an unexpected car repair can force someone to sell their investments at exactly the wrong moment, potentially locking in a loss simply because they had no other source of cash to fall back on. Alongside that emergency fund, Daniel also had to deal with a chunk of high-interest credit card debt left over from a rough stretch a couple of years earlier. And here, the math is almost never close. Paying off debt, sitting at 20% interest or higher, offers a guaranteed return that no stock market index can reliably promise. So before he poured everything into his investment account, he aggressively knocked out that debt first, freeing up even more room to invest once it was gone. Only after those two foundations were in place, a cash cushion for emergencies and freedom from high-interest debt, did it make sense for Daniel to fully commit to consistent, aggressive investing. This order of operations, foundation first, growth second, is one of the most consistently repeated pieces of guidance across financial research. And it's easy to understand why, because the biggest threat to any long-term investing plan usually isn't a market crash. It's being forced to sell during one because you had no other options. Let's talk about the actual numbers for a moment, because this is where the story stops being abstract and starts becoming something you can picture in your own life. If you invest $500 every single month and earn a hypothetical average annual return of 7%, which is on the more conservative end of long-term historical stock market performance, after 10 years, your own contributions would total $60,000, while the account itself could be worth somewhere in the neighborhood of $86,000. Meaning roughly $26,000 of that total came purely from growth you didn't have to lift a finger for. Push that same plan out to 20 years, and your contributions total $120,000, while the hypothetical balance could be sitting somewhere around $260,000, more than double what you actually put in. Stretch it all the way to 30 years, and your personal contributions add up to $180,000, an amount that sounds significant on its own, except the hypothetical account balance at that point could be sitting somewhere around $610,000, meaning roughly 70% of that final number came from growth, not from money you personally deposited. These figures are illustrations built on assumed average returns, not guarantees. Actual markets are far messier than any straight line projection. Some years will surge, some years will fall hard. Fees and taxes and inflation will all take a bite out of the final number, and nobody, no matter how confident they sound online, actually knows what the market will do next year, next decade, or the decade after that. But the broader pattern, small, consistent contributions, plus a long enough time horizon, plus a reasonable long-term rate of return, has held up across nearly a century of market history through wars, recessions, pandemics, and crashes that each felt, in the moment, like they might be the exception that finally broke the pattern for good. There's an ongoing debate in the investing world worth mentioning here, because it comes up constantly. The question of whether it's better to invest a lump sum all at once or spread it out gradually the way Daniel did. Historical research comparing these two approaches has generally found that investing a lump sum immediately tends to outperform spreading it out over time in roughly 2 out of every 3 historical periods studied, simply because money that's invested sooner has more time in the market to grow. But that statistic misses something crucial about how actual human beings behave under stress, because the emotional toll of watching a large lump sum lose value all at once, right after you invest it, causes real people to panic and abandon their strategy in ways that a spreadsheet can never capture. For someone without a large lump sum sitting around anyway, someone simply investing whatever they can out of each paycheck the way Daniel does, this debate is somewhat academic. Because dollar cost averaging isn't really a choice for people in that position, it's simply what saving out of a monthly income naturally looks like. The real lesson buried inside this debate isn't about which strategy wins on paper. It's about picking a strategy you can actually stick with when things get scary, because the best investment plan in the world is worthless if fear convinces you to abandon it at the exact wrong moment. It's worth pausing here to explain what Daniel was actually investing in, because the word investing scares a lot of people away simply because they picture something complicated, a trading screen full of blinking numbers, a stockbroker in a suit, some secret system only insiders understand. That's not what this looked like at all. Daniel wasn't picking individual companies, trying to guess which one would be the next big winner. He was buying small slices of an index fund, a single investment that pools together shares of hundreds of different companies at once, spreading his $500 across the largest businesses in the country instead of betting everything on one. This is sometimes called diversification, and the logic behind it is almost embarrassingly simple. If you owned stock in only one company and that company had a terrible year, your entire investment could get wiped out along with it. But if you owned a tiny piece of 500 different companies, one business having a disastrous year barely moves the needle because it's being balanced out by hundreds of others having an average or even a great year at the same time. Historically, broad market indexes tracking the largest publicly traded companies have delivered average annual returns in the high single digits to low double digits over multi-decade stretches, even after accounting for every recession, every crash, and every period of panic that happened along the way. Look at the year-by-year numbers, and it looks like chaos up close. A year of losses over 20%, followed a few years later by a year of gains over 30%, followed by a handful of quiet, unremarkable years in between. And yet, zoom out far enough, and that chaos smooths into a long, steady upward slope. This is exactly why trying to guess the market's next move, jumping in when it feels safe and jumping out when it feels scary, is so much harder than it sounds, and so much less effective than simply staying in the game the entire time. Daniel also learned, somewhere in his late 20s, about the difference between investing inside a regular brokerage account and investing inside a tax-advantaged retirement account. And the difference turned out to matter more than he expected. Certain retirement accounts allow your contributions to grow either tax-deferred or completely tax-free, depending on the type, meaning the government isn't taking a cut of your gains every single year the way it might with a regular taxable account, which lets compounding work even harder over long stretches of time because none of the growth gets skimmed off along the way. On top of that, if an employer offers to match a portion of what you contribute to a workplace retirement account, that match functions almost like an instant, guaranteed return on your money before it has even had the chance to grow a single dollar in the market, which is why so much financial guidance repeats the same basic advice. Contribute at least enough to capture the full employer match before directing extra money anywhere else, because turning that down is effectively refusing free money that would otherwise be sitting in your account working for you. None of this required Daniel to become an expert. He didn't spend his evenings reading balance sheets or picking apart earnings reports. He simply picked a small handful of low-cost, broadly diversified funds, automated his contributions, so the decision to invest was made once and then repeated itself every month without him having to think about it again, and then got out of his own way. That last part turned out to be the hardest part of the entire process, not the investing itself, but the discipline to leave it alone. Because the biggest threat to Daniel's plan was never really the market, it was Daniel. The version of him that occasionally wanted to check the balance every single day, or panic during a downturn, or chase some flashier opportunity a friend was talking about at a party. Let's fast forward. Daniel's now in his mid-30s. He's been contributing for over a decade. His $500 became $750, became $1,000, and along the way he opened a tax-advantaged retirement account, contributing enough to capture any available employer matching funds before anything else, because turning down a full employer match is often described as leaving free, guaranteed money on the table, an opportunity cost too large to ignore. He's lived through at least one more sharp market downturn since he started, watched his account balance drop by a number that would have terrified him back when he was 24, and felt almost nothing this time, not because he stopped caring about money, but because he had lived through enough cycles by now to trust the pattern. Down, sideways, recovery, new highs, down again, sideways again, recovery again. Somewhere around this point in the story, Daniel isn't really thinking about the stock market day to day at all. The contributions happen automatically. The account grows in the background of a life that's mostly about other things, his job, his relationships, his hobbies, his ordinary days. That, more than any specific dollar figure, is arguably the real point of building an investing habit early, not obsessing over every market headline, but building a system quiet enough that it works whether you're paying attention to it or not. By the time Daniel reaches his 50s, the account that started with a single $500 contribution when he was 24 has grown into something that would have sounded like fiction to the version of him sitting on the edge of his bed all those years earlier. He didn't get there through some secret stock pick or a lucky bet on a single company. He got there through a boring, repeatable process, automatic contributions, increased whenever his income allowed it, left alone through downturns instead of sold in a panic, protected by an emergency fund so he never had to touch it out of necessity, and given enough time, decades of time, for compounding to do the quiet, unglamorous work it always eventually does. If Daniel could go back and say one thing to his 24-year-old self, staring at that $500 number and feeling like it wasn't enough to matter, it probably wouldn't be about picking better investments or predicting the next crash or finding some clever trick nobody else knew about. It would be simpler than that. Start now, with whatever amount you can actually sustain, because the size of your very first contribution matters far less than most people assume. What actually matters is whether you keep going long enough to let time do what time does best. Markets will crash again. They always have, and they almost certainly always will. Headlines will scream that this time is different, and for a while, in the middle of it, it will genuinely feel that way. But history, stretched out across decade after decade, keeps telling a version of the same story. The people who stay invested through the fear, who keep contributing when it feels pointless, who resist the urge to let a bigger paycheck quietly become a bigger lifestyle instead of a bigger investment, tend to end up somewhere their past self would barely recognize. None of this is a guarantee. Nobody can promise you what the market will return over the next 30 years, and anyone who tells you otherwise is selling you something. What history does show again and again, through crashes and recoveries and booms and busts stretching back nearly a century, is that consistency and time have quietly built more wealth for more ordinary people than almost any clever strategy ever has. $500 a month isn't a magic number. It isn't going to make you rich by next year, and it was never supposed to. What it can become, if you protect it with an emergency fund, free it from high-interest debt, increase it as your income grows, and most importantly, refuse to touch it out of fear when the market inevitably drops, is the foundation of a financial life that looks nothing like the one you're living today. There's one more thing worth sitting with before this story wraps up, and it's the fact that Daniel was never a finance person, not before he started, and not really even years into the process. He didn't have some innate gift for numbers. He wasn't glued to financial news every morning. He wasn't the friend everyone came to for stock tips at a barbecue. What he had, more than anything else, was a system simple enough to survive his own inconsistency, an automated contribution that didn't require willpower every single month because the decision had already been made once and then left alone to repeat itself. This turns out to be one of the most underrated truths in personal finance, that the people who build real long-term wealth are rarely the ones with the highest returns in any single year. They're the ones who never had to make the same difficult decision twice, because they removed themselves from the equation as much as possible. Every time Daniel's paycheck landed, $500, then $750, then $1,000, left his account before he ever had the chance to spend it or second guess it. And that small piece of friction removed, the fact that he never had to consciously choose to invest each month, turned out to be worth more than almost any clever strategy he could have used instead. Think about how different this looks from the way investing gets portrayed almost everywhere else. The dramatic stock picks, the overnight winners, the people online bragging about doubling their money in a single trade. Daniel's version of building wealth looked almost nothing like that. And most months, it looked like nothing was happening at all, which is precisely why so many people give up. Before it ever has the chance to work, they're waiting for a version of investing that feels exciting. When the version that actually builds wealth reliably tends to feel closer to watching paint dry, at least for the first several years. If there's a single mindset shift buried inside this entire story, it's this. Stop asking whether $500 a month is enough, and start asking whether you can sustain it for long enough to matter. Because sustainability, not size, is the variable that actually determines the outcome for almost everyone who isn't already wealthy to begin with. A person investing $500 a month consistently for 30 years will, in almost every historical scenario, end up meaningfully ahead of someone investing twice as much for only a third of the time, simply because time is doing so much of the heavy lifting that the size of any individual contribution starts to matter less than most people assume. The account Daniel opened at 24 wasn't really about $500. It was about a decision, made once, on an ordinary night, to stop waiting for the perfect moment or the perfect amount, and to simply start. Because in the end, that single decision to begin, and to keep going, is the part of the story that actually changes everything.